Hi, I'm Jimmy. In this video, I'm going to walk through my top 3 dividend stocks from the information technology sector. Our goal is to find dividend stocks that can give us passive income that ideally could help us get closer to our goal of achieving financial freedom. Okay, now this video is part of our passive income from dividends series, where we try to put together the top dividend stocks from each of the 11 GICS sectors. GICS is short for Global Industry Classification Standards. This is the second video in that dividend series, or second video the second time around. The first video we did was on the energy sector just a few days ago. I'll have links in the description below. And I'm trying to focus on companies that have a dividend yield of more than 3%. Now, when I say this is the second video the second time around, is we actually did this same series back at the end of last year. But let's face it, a lot has changed in the stock market since the end of 2019. And since a lot of stocks have seen their prices collapse, well, in many cases, the dividend yield has gone up since it costs us less to buy the stocks that, in theory, pay the same or close to the same dividend. Okay, our first IT dividend stock is IBM, short for International Business Machines, ticker symbol IBM. IBM has a dividend yield of about 5%. And then we switch over to IBM's stock chart. Well, we can see that IBM has pulled back right alongside the stock market crash during this whole epidemic from the coronavirus. Now, IBM has gone out of its way to focus on liquidity, which I think is very smart during these unusual times. They've brought their cash level to about $12 billion as of the most recent quarterly statement. And then the flip side of that is their debt. And they have about $63 billion in debt as of the end of the first quarter. But the good news is that $22 billion of that $63 billion is tied to their global financing business. And IBM has access to about $15 billion in credit, so that should give them some additional liquidity if they happen to need it. And this brings us to their dividend per share chart. And as we can see, IBM's dividends per share has gradually increased, and this is one of the reasons that dividend investors tend to like IBM. And then when we add adjusted earnings per share to this chart, well, we can see that their profits, which is the same thing as earnings, well, they've done a great job of covering their dividends over the long run. So even if we were to see a decent pullback in their earnings from the whole coronavirus epidemic, well, I would expect for their dividend to stay safe, at least for the foreseeable future, and likely in the long run. So if passive income from dividends is something that we're after, I think IBM is one of the top companies out there for us to consider. Okay, next up, we have HP, ticker symbol HPQ. HPQ has a dividend yield of a bit more than 4.5%. And then we switch over to their stock chart. Well, now we can see that HP is down about 20%. And on top of that, HP is coming off of some big news. So at the end of last month, Xerox, another interesting dividend stock in the same sector, well, Xerox dropped their bid to buy HP. Now, Xerox came out and said that they dropped their bid because of concerns over the uncertainty of the coronavirus, which I suppose is understandable. But this could also imply that it's possible that this bid comes back, perhaps after concerns are, let's say, lower than they are today. Okay, now, HP seems to have a decent amount of cash. They have about $4 billion in cash and only about $6 billion in debt. So, and that debt includes, if we were to count the leases, the long-term leases as debt. So overall, I think HP is well positioned to survive the current pandemic. Although I do expect a pullback in their revenue and ultimately their profits. Now that leads us to their dividends per share. And as we can see, they've been somewhat consistent, although not as consistent at first glance from the increasing of their dividends. But I think it's important to point out that this drop here in 2016, well, this came after the 2015 HP spinoff of the Hewlett-Packard Enterprise company. So I'm not sure it's fair to say that this is a real drop-off, because if we owned the stock at that time, well, we would have ended up with shares in both HPQ and Hewlett-Packard Enterprise. So now if we focus on their more recent dividends, and then we add earnings per share to this, well, we can see that profits do a good job of more than covering their dividends. So even if Xerox is right and HPQ runs into a slowdown along with the economy, well, I expect for their dividend to remain fairly safe over the long run. Okay, now I know I'm running through these companies fairly quickly, and if you think we should do a deeper dive on any one of these companies, or even if it's another company that's also in the information technology sector, just not one we're touching on in this video today, please let me know in the comments below. That could be interesting to do. Okay, next up we have a slightly different company, and that is Broadcom, ticker symbol AVGO. Broadcom has a dividend yield of about 4.8%. And when we look at their stock chart, well, we can see that Broadcom's stock is down like most of the other companies. And if we're curious, on a total return basis, the stock is down almost 14% year to date. So let's jump right into the question marks that I have in my mind about this company. And that is, this is their dividend yield, or their dividends per share, not dividend yield. But as we can see, they've had very impressive dividend growth. But then when we add earnings per share, well, we can see that profits have not been consistently covering their dividends. And this, at first glance, tells me that Broadcom might consider slowing down the growth of those dividends, or at least slow them down at a rate that until earnings can significantly outpace their dividends. Now, that's not to say that I don't think that their almost 5% dividend yield isn't sustainable. I'm just saying that I would prefer them to keep their dividends at a reasonable level than have to one day lower those dividends. Now, I will say that their earnings, as we can also see, have done a good job of growing over the years, and I expect that to continue as well. So I don't know if this is a huge problem right now, but I did want to bring out that I like this company because I like fundamentally how they're set up, not necessarily the growth of their dividends or that I expect them to keep the current growth of their dividend, the current growth rate of their dividend. So the reason I actually like Broadcom, specifically after the stock pulled back, is because Broadcom isn't as exposed as some of the other companies in the industry. I would expect for their cloud business to do fairly well. They have a telco business that's likely to do quite well during the pullback from this pandemic. Then on the flip side, they have a mobile business that is likely to get hurt. And although the cloud business and businesses like that could partially offset the pain in the mobile business, I think that overall their business diversity should help their long-term growth. Plus the fact that they're one of the leaders in what they bring to the table. So upstarts right now that would ultimately compete with them are going to run into more trouble than they are right now. So I wouldn't be shocked if we saw a pullback in their overall business, let's say revenue and profit. But I would expect for them to do better than some peers. And I think that they will be better positioned after this whole coronavirus pandemic is over. I think that they'll be better positioned for the long run. Okay, now maybe we like these companies, but let's face it, some IT companies could be a bit more volatile than the broader market. So perhaps we might look at something like the ETF put out by Vanguard, which is a pretty good ETF that covers the information technology sector. It's the Vanguard Information Technology Sector ETF, ticker symbol VGT. Now, it only has a dividend yield of slightly more than 1%, but it does have over 300 companies in it. So if diversification is what we're after, VGT could be a good play for the industry. Now, if we're not sure of what we like better, stocks or ETFs, I actually did a video not long ago where I compare investing in stocks versus investing in ETFs. And if we're curious, perhaps that could be a good next video for you to watch. There's a link right here. There's a link in the description below. And I want to thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thanks, and I'll see you in the next video.